Hello everyone, this is Juan Sarmiento and today is Friday, June the 23rd. Okay, here we have our accounts, cover calls. Let's go to the monitor, account statement, and so far you remember we started with 100,000 on the IRA account, 50,000 on the margin account. And as you can see, they both have about the same P&L for the year, about $3,400. Okay, not bad. Yeah, you might say, well, we were lucky to have entered those positions when the market was down and the market went up. Okay, well, whatever. Let's just take a look at what happens when the stock goes below and when it's above the strike price. Okay, so today we have two expirations that I would like to look at: Etsy and let's see, the other is MOS. MOS, let's click here and go to the Analyze tab, and you can see that the option that we have sold is completely out of the money, so there is no extrinsic or intrinsic value and it will expire worthless. Okay, so if you take a look at the risk graph, we are right there. So we are actually 18 below, so we didn't make any money on that except for the fact that the options, which had an extrinsic value, now have nothing. So we got to keep the extrinsic value. Now you might say, well, yeah, but the stock went down significantly. Well, the idea here is that the stock goes up and down, but every month we collect that amount. That is the extrinsic value of the option we are selling. Now, what happens when when the stock goes below? It's right there at 34 and my strike price is 36. So that means that I'm just a few dollars below the loss, the maximum, just a few below the break-even point, which means we are losing money. We're losing money on the stock, but not on the short. The short simply expired worthless. If the stock has gone up, then we make money on the stock itself and we get to keep the extrinsic value, but we lose in the intrinsic value. But the intrinsic value goes up along with the stock price. I know if it might not be clear, but what we are collecting, we get to keep. That's the purpose of this. And in the long run, we keep collecting. And presumably, if the stock maintains its value, then we can be collecting for as long as we want to. Okay, let's go and look at the add simulated trades, because now we want to roll over this position. So you can select this call and say analyze rolling. Okay, now we need to select the expiration date. Well, I would say about a month from now. So let's close that and look for the option that is about a month from now. 28, that sounds good, or 35. Yeah, that's about it. We'll see which one of the two is more interesting to me. We are going to select the option with the least intrinsic versus extrinsic value. We want the extrinsic value to be high, but you see, for example, it says here 1.41. Well, you will subtract the intrinsic value to get the most. Okay, so the average. I would say let's try this one. So I will click here and you see you can say 185 and sell it at that value, 385, something like that, 1.38. Or we can go here to this one, which is 5 days, a week later, and the extrinsic value is 1.39. So only a couple of cents more. So I would say, all in all, by comparison, this makes a better sense. Okay, so I'm going to do the July 21st, and what is the strike price here? 34 and a half. Yeah, you can do that, 34 and a half. That's the current, below the current stock price. Okay, so 34 and a half is what we're selling now. It's a sort of a weird strike price, but we get to sell it. And times 3. So then you have the risk graph here. And so here we have the $29, $30, but when I do this, let's set the expiration to two expirations. It's not showing it, but I could say with some certainty that this will be my maximum. Is $460 will be my maximum gain. But regardless, is this 1.37 times 3. So this is how much we are getting. 1.38 times 300. $414 is what I'm getting for this option. Okay, ideally you will get 500. Okay, 500 would be better. The strike price of the option I'm selling is about 40%. All right, so I'd say let's do it, and we'll see if we get to recover some of the money. Definitely, if the stock goes up, we will definitely make up for that. But overall, we are still ahead, and that's all that matters. Okay, so this, you can say, okay, I'm going to simply close this position, or you can say, well, I'm going to keep on selling. Let's look at the chart here of Mosaic, because we need to look at the option. Yeah, it's kind of the value of the option is coming down a little, but it should be increasing, meaning the extrinsic value if the volatility is higher. 40 sounds like a high volatility to me. Okay, let's just do it, all right? Instead of, because we have plenty. This was the only, if I didn't have any other cash to get into new positions, I'd probably say, well, you know what, let's do this, use this cash on a better position, meaning an option with higher volatility. But because I really don't have any better candidates, we can do this. Okay, so, and I'm going to do the same for both accounts, the margin as well as the IRA account. So I go say confirm and send, but I'm going to say multiple accounts. Okay, so we can say 3 trade, 3 options, and you can see that the buying power effect, what it is. Okay, let me do this first on the IRA first. I send it and I didn't want it just now. Let's cancel that for a minute because it's canceling it. So let's wait a second here. I wanted to see, okay, what is the real power? Okay, let's go to the account statement and look for MOS, and here we have what is our market value is $10,260. Okay, so when I do that, you can see that I get the credit of $411 plus the commission, and and this is the buying power. Seems like a little higher than I expected. I would have expected $10,000. Okay, let's send it and see what happens. It seems not correct. And we're going to do the same for the IRA, for the margin account. And in this case, there is zero buying power effect because we're switching calls. Okay, that's say all accounts, and here they are. I'm asking for a credit of 137, and it's saying for 138. So that should be filled shortly, momentarily. Okay. The other, while we wait for that, let me go for Etsy here, and let's go to the Analyze tab, and here we are right at the maximum profit area. Perfect, because we have the 90 calls and my options. Yeah, we are at 90.04 is my 90.01 is very, very close to expiring worthless. So go to the Add Simulated Trades and look for it right here. It says 0 because it expires today. And look for the intrinsic in the extrinsic value. That's 50 cents. This should be 0. Okay? So why is not? Well, because somebody expects this stock to move still. So what am I going to do? Well, I can wait until this goes to 0 or close to it before doing the rollover. And why is it 52 cents? Well, somebody expects the stock to go up 52 cents. And right now it fell below 1. So if I went and say analyze rolling, and how am I going to roll this to? Well, look for, again, the option with the most extrinsic value, and that would be this one here, the 90 expiring on July. Okay, so come over here, July 21st, and then we get $4 for that, 405. Get it? It really should be 450. And I could certainly put that 450 here and correct as we get closer because it might not fill. Okay, I'm going to do that. And again, we're going to do both for the margin as well as the IRA accounts. I'm going to set it up, maybe it gets filled, and come and check it out before the market is closed. Okay, so I'm going to say multiple, and then do this, send it, and we'll see what happens. Okay, that's all for today. So this is just an indication how this is to be done, and if you have any questions, please post them in the comments below. I'll be happy to answer. Bye bye.